Kevin Prendergast, Director of Wealth Management here at the Retirement Network, Leland Smith. I'm recording this video on Friday, September 22nd. Two topics today, the usual, the August 2023 minimum present value segment rates. But first, something you could be doing within the AT&T 401k retirement savings plan based on market conditions at the moment. Okay, so I'm going to share my screen here, get into a couple visuals. First things first, if after watching this video you have questions, feel free to reply to the email containing this video. We do monitor that inbox. Otherwise, you can click the Get Your Free Assessment button, follow the steps from there. Okay, so let's talk about the AT&T 401k retirement savings plan first. All right, and what you're seeing in front of you, go to the year-to-date view, or the one-year view, excuse me. We can see that the stock market is a bit undervalued. Stock prices have gone down a little bit, particularly in recent weeks. So we have a little bit of an undervalued status. So this bold black line is kind of equilibrium stock price, meaning stock prices are roughly equal to what the underlying businesses should be worth based on estimates surrounding their fundamentals. All right, so revenue, profits, etc. So whenever we're below that line, it means that stocks might be a little bit undervalued. Okay, so a good opportunity to keep funding the 401k. Obviously, you want to do at least 6% to capture that full match. If you have the cash flow, if you have it in your budget to ramp things up a little bit at this time, a good time to do so with stock prices being 5 to 10% undervalued by this estimate. And the purest exposure you can get to the stock market is through the large cap US stock index. There's a fund on the menu of choices available to you called the large cap US stock index. That's a good low cost option to get you exposure to several hundred of the biggest companies that are publicly traded and based here in the US. That's a good option to consider within the menu. All right. Perfect. So let's get into the August rates. Still elevated. So we had a Federal Reserve meeting and subsequent press conference earlier this week. Seems like rates are going to remain elevated for the foreseeable future. The Fed has the most direct influence on the first segment, right? Kind of the short end of things. And then the market has a bit more control, meaning all of the various market participants, very complex place, have more influence over the second and third segments. We are still elevated to where we were in November, relative to where we were in November, right? So the first segment has crept up a bit higher. The older you are, the more impactful that is. All right, second segment is roughly equivalent, a little bit down from last November. Third segment is a bit higher than November. So rates are still elevated. That means if you're more inclined to take the lump sum and you're not yet 65, right? At age 65, something happens where the rates kind of lock in for you, generally speaking. So you're not yet 65, you're inclined to take the lump sum. It means we're probably going to want to be patient with these rates. Could take several years for them to come back down. We might not ever again see rate, at least not in your careers, see rates back at the 2020, 2021 levels. We might not go back to those levels. So that might not be a reasonable expectation. But if we're patient, if we wait a couple of years, these rates might come back down from where they are now. So definitely be some patience required, again, if you're not yet 65 and you are inclined to take the lump sum rather than the monthly annuity. Okay, hopefully this is helpful. See you next month. Bye.